As usual, we start with our key messages that are emerging from this forecast. First, following a robust post-pandemic expansion in 21 and 22, the EU economy has lost momentum, so we are in a challenging year also for economy. Real GDP barely grew in the first 3 quarters of this year. Over the coming quarters, though, growth is expected to rebound mildly as consumption recovers with rising real wages and investment remains supportive. This is the first message. Second message, inflation has declined rapidly since spring and is projected to continue easing over the forecast horizon. Third, the strength of the labour market remains, and it is the main underlying force behind the outlook. Fourth, the government deficit ratio in the EU is set to drop below 3%, and the debt ratio continues declining. And final message, downside risks and uncertainty increase, especially amid heightened geopolitical tensions. So the growth momentum in the EU economy remains very weak. Both the Commission's economic sentiment indicator and the Eurozone PMI indicate a gradual loss in growth momentum so far this year. The PMI suggests that the weakness in industry at the start of the year has spread to services, which entered contractionary territory during the summer. The latest October data from our surveys indicates some stabilization in sentiment at a low level. Among the factors business managers see as limiting production, insufficient demand has further gained prominence, while shortages of material and/or equipment continued to diminish. So private consumption to drive moderate rebound. Because the loss of momentum this year has been underpinned by the lack of a solid growth driver, with weakness both on the external side and especially among consumers. Private consumption has broadly stagnated so far this year, as nominal wage growth continued to lag behind inflation. Meanwhile, net trade is set to contribute positively to growth this year, as the decline in imports is outpacing that in exports. Investment, both public and private, increased, but they increased only slightly in the first half of the year, and so they are expected to contribute very little to growth in 2023. Over the next 2 years, private consumption is set to be the key growth driver, as wage increases should outpace inflation, lifting households' purchasing power. A robust labour market is also set to contribute. The recovery in private consumption could be even stronger in the absence of the high savings rate expected to persist over the forecast horizon, a reflection of consumers' high uncertainty over their future financial situation and downbeat sentiment keeping precautionary savings high. So private consumption in the EU is projected to grow by only 0.4% this year, before accelerating 1.3% next year and 1.6% in 25. Investment is set to grow steadily in spite of high interest rates, as strong corporate balance sheets provide room for investments. Infrastructure investment is also set to grow, benefiting from public spending and funding from the RRF and REPowerEU. Total investment growth in the EU is expected to slow to 1.2 in 23, to peak up to 1.5 in 24, and 2.3 in 25. This is the investment growth. Overall, The result is that we project GDP growth in 23 at 0.6% in both the EU and the euro area. 10 member states will, however, have negative growth this year. EU GDP growth is forecast to accelerate to 1.3 in 24 and 1.7 in 25. In the euro area, slightly lower, 1.2 in 24 and 1.6 in 25. Global level, a sluggish global economy is expected next year, and the environment is expected to remain challenging, with growth rates below the historical average, which was 3.8% between 2000 and 2019. It decelerated to 3.3 in 22, and it is projected to reach 3.5 in 23. Growth is forecast to inch down to 3.2 in 24, as the effects of tight monetary policy continue to weigh and the slowdown in China continues, and finally to pick up to 3.5 in 2025 as the recovery in advanced economy takes hold. But as I said before, the average in the first 2 decades of the century was 3.8. Global trade growth is expected to rebound in 24 from the anemic rate of this year and to strengthen further in 25. Accordingly, EU exports to the rest of the world are projected to pick up over the forecast horizon, though at a moderate pace. However, as imports also recover in line with economic activity, the contribution of net trade to GDP growth is set to be broadly neutral in 24 and 25. Improved terms of trade set to consolidate external surpluses. While global trade has been particularly weak this year, the EU's current account balance has improved significantly thanks to falling energy prices. Our current account surplus is set to improve to 2.5 in 23 and stabilize at that rate over the forecast horizon. However, as global energy prices are assumed to persist at higher than pre-war levels, and the EU is set to lose market shares globally, the balance of goods in the EU is expected to remain well below its pre-pandemic level over the forecast horizon. In contrast, the balance of services is assumed to stay above the pre-crisis level. Now, energy prices. The reaction of oil and gas prices, both spot and futures, has remained overall muted despite the situation in the Middle East. I mean the situation we are now. The gas futures price curve remains broadly in line with the assumption underpinning the summer forecast, with gas prices falling gradually towards €45 for megawatt hour by the end of 25. Oil prices futures over the forecast horizon have moved slightly higher, around 5% higher than assumed in summer. As such, the disinflationary impulse, which was very strong, from energy prices over the forecast horizon is said to be less prominent. Monetary policy tightening is working its way through the economy. The ECB last hiked its interest rates in September by 25 basis points, and markets expect the bank to keep them at this level before gradually cutting them by end 2025. This is the market expectation. The path of expected policy rates has only marginally increased since summer, but financing costs have increased more visibly, and the provision of credit to the private sector, both through banks and markets, has continued to slow. The decline in bank lending is due to both tighter credit supply conditions and lower demand. Overall, financing conditions remain tight and are set to weigh on growth over the forecast horizon. The labour market. Our labour market continued to perform strongly in the first half of 2023, despite the slowdown in growth, which is there since the start of the year. Activity and employment rates reached their highest level on record, while unemployment remained close to its record low. However, there are signs of some cooling. Employment expectations are reported in our business surveys remain above their long-term average, but have declined throughout most of 2023. Some member states have seen an uptick in unemployment. And this is probably related also to the fact that data on bankruptcy declarations in the EU point to a rising trend over several quarters, though the level of insolvency remains moderate. The pace of job creation eased in the first half of the year and is expected to decelerate further, but the EU economy is still set to create jobs over the next 2 years. Employment growth is forecast at 1% this year before easing to 0.4% in 24 and 25. Low unemployment rates suggest that the labour market is set to remain tight and exert upward pressure on wages. Nominal wage growth is expected to accelerate further this year before gradually moderating in 24 and 25. Importantly, this forecast sees wage growth exceeding inflation in those years, finally allowing workers to recoup, at least partially, purchasing power. So now our growth map for 23 and 24. And the outcomes are variable across different member states. In 24, all for 23. In 24, almost EU economies are expected to resume or continue growing before experiencing a somewhat stronger expansion in 25. But in 23, the situation is very differentiated. The German economy is expected to contract by 0.3% this year, a loss in purchasing power due to high inflation and tightening financing conditions is weighing on consumption and investment. Foreign trade has evolved less favorably than expected. Going forward, private consumption is set to pick up, driven by real wages increase. Together with recovering foreign demand, this is expected to support a moderate rebound in growth in Germany to 0.8 in 24 and 1.2 in 25. Economic activity in France is set to grow moderately this year as inflation remains and tighter financial conditions weigh on growth. GDP is expected to gain momentum over the forecast horizon as private consumption accelerates and inflation progressively decreases. So GDP is expected to grow by 1% this year, 1.2 in 24 and 1.4 in 25. In Italy, economic growth slowed this year, with consumption squeezed by high inflation and investment starting to contract after the post-pandemic expansion. After modest growth of 0.7% this year, a moderate acceleration is expected next year, 0.9 and 1.2 in 25, also supported by RRF-funded investments. In Spain, following a strong start of the year, economic activity is set to decelerate in the second half of 23 and 24. Anyway, growth is expected to reach 2.4 this year and 1.7 in 2024, before picking up again to 2% in 2025. Labour market resilience and wage growth supported strong economic activity in 23. In 24, growth is expected to be led by a pickup in investment, largely thanks to the RRF-funded investments and private consumption. The Polish economy remained weak in the first half of this year, pointing to a modest 0.4% expansion in 23. Growth was depressed by falling private consumption and a drag from inventories, while net exports and investment supported activity. Next year and in 25, growth is projected to accelerate to 2.7 and 3.2 respectively. Private consumption said to be the main growth driver as real wages increase and inflation fades. Investment and net exports are set to support growth in Poland. And let me take this opportunity also to say a word on Ukraine, which we are covering in our forecast for the first time this autumn, along with the other two countries that were granted EU candidate status, so Moldova and Bosnia-Herzegovina. In Ukraine, after collapsing by 29% in 22, following the Russian invasion, the economy has shown remarkable resilience in 23, with growth projected to reach 4.8% this year. This can be attributed to exceptional harvests and, of course, government stimulus underpinned by the unwavering support of international partners, as well as to the authorities' commitment to ensure macro-financial stability. Now, inflation. Inflation, as you know, has fallen sharply, reflecting a broad-based deceleration in consumer prices. Energy prices have kept declining, and all other components saw inflationary pressure moderate, pushing headline inflation in the euro area to 2.9% in October. And this is almost 8 percentage points down from the peak of 10.6, which was reached in October last year. And this 2.9 is the lowest since mid-2021. Inflation is set to continue declining next year and in 25, though at a more moderate pace. This reflects continued easing of inflationary pressures in food, manufactured goods and services. However, given the recent rise in energy commodity prices and the assumed expiry of energy measure, consumer energy prices will no longer push in a decisive way inflation lower. So headline inflation in euro area is projected to fall from 5.6 in 23 to 3.2 in 24 and 2.2 in 25. In the EU, the figures are 6.5 in 23, 3.5 in 24, and 2.4 in 25. This pace of decline is somewhat slower than projected in the summer, reflecting higher on average energy commodity prices. We have also an EU inflation map, and while moderation is underway and projected to continue everywhere in 24 and 25, the pace of this reduction differs widely across the Union. Inflation is expected to remain significantly higher in the Central and Eastern European, mostly non-euro area member states. Now that the imported commodity price shock has largely subsided, inflation differentially largely reflect domestic drivers, and these include differences in wage growth and developments in profits and markups across member states. Now on public finances. After reaching the historically high level of 6.7% of GDP in 2020, the EU deficit fell to 3.3 in 22 and is set to decline slightly to 3.2 in 23, despite the less favorable economic environment, which is very different in 23 than in 22. The complete phase-out of pandemic-related temporary measures, as well as a lower net budgetary impact of energy-related measures, have contributed to this fall, despite the very different figures on growth. In 24 and 25, restraint in discretionary fiscal support is expected to lead to further deficit reduction to 2.8 and 2.7 of GDP overall on average. The estimated net cost of energy-related measures are declining rapidly and are expected to be completely phased out in 25. These savings are outweighing the increased impact of higher interest expenditure for governments. Overall, these developments imply a contractionary fiscal impulse in 23 to 25, so that fiscal policies are not expected to fuel additional inflationary pressures. The debt-to-GDP ratio also fell significantly to 85% in 22, from the record high of 92% in 2020. It is projected to decline further to 83% in 23, and then broadly stabilize just below 83%. In the euro area, where debt peaked at 99% in 2020, the ratio is estimated to drop to 90% in 23, before also stabilizing around that level of 90%. So we have also the budgetary outlook map. This year, several member states are still projected to see a deterioration in their general government balance, while lower energy prices are helping to contain the cost of existing support measures. Many governments introduced new measures or extended already existing ones. In 24, the deficit reduction is said to be more broad-based across countries, driven by the significant further phasing out of energy support measures. The number of countries with a deficit exceeding 3% is set to increase from 10, as they were in 22, to 12 in 2023, before falling again to 8 in 24 and increase again to 13 in 2025. And this, of course, is based on unchanged policies, which is the only way we can, of course, base our estimate. In conclusion, the risks, because, as you know, uncertainty and downside risks for this economic outlook are always increasing. They are primarily related to the evolution of the Russian war and to the new and tragic conflict in Israel and Gaza. Energy markets appear most vulnerable, as renewed disruption to energy supplies could potentially have a significant impact on energy prices, global output, and the overall price level. Economic developments in the EU major trading partners, China in particular, also pose risks. Mounting risks associated to climate change also weigh on the outlook. Natural hazards like heat waves, fires, droughts, and floods, which have been raging across the continent with increasing frequency and scope, illustrate the dramatic consequence that climate change can have for the environment, the people affected, but also the economy. And you can see in our report the increase of the insurance prices due to these dynamics. On the domestic side, the transmission of monetary tightening may weigh on economic activity for longer and to a larger degree than projected in this forecast. So these are what we call the downside risks in our outlook that we all hope will not materialize. Bearing the risks to energy price developments highlighted above, risk to the inflation outlook appear broadly balanced. So, to sum up, we are approaching the end of a challenging year for our economy, a year where growth has slowed down more than expected. Strong price pressures and the monetary tightening needed to contain them, as well as weak global demand, have taken their toll on households and businesses. Looking ahead to next year, we expect a modest uptick in growth as inflation eases further and the labour market remains resilient. Thanks in part to the RRF, investment is set to keep increasing. Public debt and deficits are expected to pursue their decline, albeit more gradually. And heightened geopolitical tensions have further increased the uncertainty and risks clouding the outlook. This is our report, and now I'm happy to hear your questions. Thank you.
Thank you, Commissioner. So please raise your hands and I will give you the floor. Please also announce the media you're working for.